In this video, we're going to be discussing government regulation of insurance. Much of this comes from Chapter 8 of the Reda McNamara text. In order to truly understand modern-day insurance, you have to look first at the history of insurance regulation. We'll focus here on two pivotal cases and one defining law. These cases are Paul v. Virginia from 1869 and U.S. v. SEUA from 1944, both U.S. Supreme Court cases. And then we'll look at McCarran-Ferguson of 1945. So let's look at Paul v. Virginia. Samuel Paul was an insurance agent who was licensed to sell insurance out of New York, and he was selling insurance from a New York insurance company. But Paul was selling insurance in Virginia. Virginia argued that Paul needs to get an agent's license in Virginia if he's going to sell insurance in Virginia. And he needs to sell insurance from a Virginia-based insurance company. Samuel Paul's side argued that insurance is interstate commerce, and therefore there shouldn't be any interstate restrictions. In other words, he should be able to sell across state lines from a company located in New York and with a New York license. If this was true, insurance should be regulated by the federal government. If insurance is indeed interstate commerce, it should be regulated by the federal government. But at the time, insurance was basically regulated by state governments. The U.S. Supreme Court decision on Paul v. Virginia was that insurance is a personal contract between two parties, and that insurance is in fact not interstate commerce. Insurance should therefore be regulated by the state governments, just as it basically had been in the past. And also, Paul had to pay a fine to the state of Virginia, and if he was to continue to work in Virginia, he would have to obtain a Virginia license and sell insurance from a Virginia company. Remember that this was in 1869. It was 75 years later when the U.S. versus SEUA case went to the Supreme Court to revisit this idea of insurance regulation. Southeastern Underwriters Association, or SEUA, was an association of insurers that was the defendant in this case. They are somewhat similar to today's Insurance Services Office. The U.S. District Attorney, who was the plaintiff in this case, argued that SEUA was engaged in monopolistic pricing, as well as some other unfair trade practices. They were gathering lost costs and rates from all of their member companies and coming up with rates to distribute back to the member companies. In other words, they were gathering information on how much losses those companies paid out and turning those into insurance rates, and then distributing back so that the member companies could use those. This should actually sound somewhat familiar, since it's basically what ISO does today. But the U.S. Attorney argued that this was monopolistic or collusive pricing. Southeastern Underwriters Association argued that, while in fact laws relating to monopolistic pricing, for example the Sherman-Clayton Acts, are federal acts, and therefore they are not subject to federal trade practice laws as decided in Paul v. Virginia of 1869. SEUA didn't try to argue that they were not engaged in monopolistic pricing. Perhaps they believed they would lose. But they simply said that if they were engaged in monopolistic pricing, this was an okay practice because they were state regulated. The U.S. Supreme Court decision on U.S. versus SEUA was that insurance now is interstate commerce, and because it is interstate commerce, it should be regulated by the federal government. This decision actually overturned Paul versus Virginia. The court's rationale wasn't that the earlier court had gotten it wrong, but that commerce had changed, and that because commerce had changed with trucking and railroads and other mechanisms of transportation and trading across state lines, the need for insurance to cover such exposures had changed, and it made sense that insurance should be viewed more now as interstate commerce. And that decision has still not been overturned. But realize that this was in 1944. It took 75 years for there to be a decision at the Supreme Court level that changed regulation of the insurance business from state regulation to federal regulation. But it only took 1 year for Congress to come in and say that they would not federally regulate insurance, knowing that the Supreme Court case of U.S. versus SEUA established the ability and the responsibility of the federal government to regulate insurance. You might be confused, since insurance today is state regulated. That is because of McCarran-Ferguson. And part of the reason for McCarran-Ferguson was that the insurance industry felt that it needed to be able to collect data from multiple companies and use that data in setting rates, just as the industry does today. This was a legislative act that reasserted the right of the federal government to regulate the insurance business, but it said that the federal government will allow the states to regulate the business of insurance as long as the states do an adequate job. This left a sort of stick over the state regulatory bodies, saying that you better do a good job or the federal government will step in and take over regulating the insurance industry. So again, I want to emphasize that it was only 1 year after the decision in U.S. versus SEUA for McCarran-Ferguson to be enacted. Because of the threat of McCarran-Ferguson, which said that you better do a better job regulating the insurance business, all states passed rating laws within just a few years. And those laws say that rates must be adequate, not excessive, and not unfairly discriminatory. We just discussed this in the insurance operations video, but let's look a little bit more at these. First, adequate. Of course, rates must be sufficient to pay for claims, but they should not be excessive. If insurance companies are able to engage in monopolistic pricing, the fear, of course, of that is that they overprice their product because they have a monopoly on the market. But then there's this concept of not unfairly discriminatory. What does this mean? Should rates discriminate? In fact, insurance rates do discriminate by nature. That's part of what they do. They discriminate based on various risk factors, and based on these laws, they should discriminate, but they should discriminate fairly. In other words, the risk factors that insurance companies use should be reflective of the risk of the exposure and of future losses that occur under those policies. For example, homeowners' policies rate based on the age of the home and construction type. Life insurance policies rate based on whether someone smokes or not, their age at policy issuance, and their gender. But what is unfair discrimination? Well, rating on factors that are not reflective of the risk would be unfair. But there are also certain things that insurance companies are not allowed to rate based upon. Those include ethnicity, race, and religion. Even if those are reflective of risk, those are considered unfair discrimination. So, what are some of the reasons for insurance regulation? First, to maintain insurer solvency, meaning that insurance companies should have assets that are higher than their liabilities. When any company's liabilities exceed their assets, they become insolvent. If an insurance company's liabilities exceed its assets, it may be unable to pay claims. Next, insurance regulation exists to evaluate and disseminate information to consumers. The insurance business is a fairly complicated one, particularly in the area of pricing, and therefore the regulatory bodies exist to evaluate rates and coverage forms to make sure that consumers are fairly and properly protected and that the pricing of the policies is appropriate, and to ensure reasonable rates, which is related to the prior one, and to make insurance available. In other words, to make sure that those policyholders who either need insurance or are required to carry insurance have the availability of insurance. The concept here is related to the fact that insurance is a necessary part of individual family life and of business. So therefore, in order to have a healthy economy and healthy families, insurance should be available. Part of this is making sure that rates are not excessive, as we just talked about, and to provide for a non-standard market. The non-standard market in the U.S. consists of both some state government funds that we'll talk about in the next lecture and the non-admitted market, which we've discussed before. That's the surplus lines and excess markets. In prior years, insurance commissioners would say that insurance solvency was their number one goal or primary purpose. They considered their number one goal making sure insurance companies could pay claims and would not go insolvent. But possibly due to the fact that the rate of insolvency has been fairly low, most commissioners will say today, since the turn of the century, that making insurance available and affordable is their number one priority. So who does regulate insurance? I just referenced insurance commissioners, but let's look at the whole picture. Legislative bodies also are responsible for regulating insurance. Every state has an insurance code, and this insurance code comes from the legislative bodies. There are also certain federal laws, such as the Dodd-Frank Law and Sarbanes-Oxley, as well as the Affordable Care Act, that sometimes apply to the business of insurance. Then there's the judicial branch. The judicial branch interprets insurance contracts and decides on disputes, which unfortunately often occur in the insurance business, as well as interpreting the laws that were passed by the legislative body and determining how insurance companies and others involved in the insurance transaction must comply. And lastly, insurance departments, who enforce the regulations. The head of the insurance department is known generally as the insurance commissioner. A few, however, are the state's treasurer or CFO. All states' insurance commissioners automatically belong to the National Association of Insurance Commissioners, or NAIC. The NAIC now meets 3 times per year. The purpose of their meetings is to build some consistency between states' regulations. Part of the idea here is to ensure that the McCarran-Ferguson Act is not overturned. It's important to states that they maintain regulatory authority over the insurance business. The insurance industry has differing opinions on whether or not federal regulation would be better. However, at this point, the balance still leans in favor of state regulation of insurance. Keep in mind that the NAIC, though it is an important body in insurance regulation, has no regulatory authority over the insurance business. All that they can do is to pass model laws that states may or may not adopt. But it is the insurance departments themselves within each state that actually have regulatory authority. So how is insurance regulated? First, the insurance departments regulate the formation and licensing of insurance companies or carriers. In order to establish an insurance company, there are certain things that a group has to do. They have to have a plan, including an underwriting manual and a rating manual, and they have to show a certain amount of expertise, and they have to put up capital and surplus. Also, insurance departments regulate the reserves, which is a huge liability for the insurance companies, and the investments, which are of course a huge part of an insurance company's assets. Reserves and assets are both fairly conservatively regulated, and insurance departments regulate rates. We'll look at this again in a moment. But finally, insurance departments also regulate the policy forms. The insurance department generally gets a copy of the forms that are used in the standard insurance market. Let's look at rate regulation a little more closely. There are different types of rate regulation, from most restrictive to least restrictive. There is state-mandated rates, which are most restrictive. These are only used in certain lines of business and only in a couple of states. Then there's prior approval, where the state insurance department actually has to approve the rates before they're used. Then there's a thing called flex band prior approval. Louisiana uses a form of flex band prior approval. Personal lines property and liability insurance rates are flex band regulated. The way this works is that any rate change higher than 10% must go through a prior approval process. Other rates are file and use, modified prior approval, or open competition, depending on the line of business. If an insurance company wants to increase a homeowner's or auto insurance rate more than 10%, they must first get the permission of the state insurance department. However, if they change their rates in a given year less than 10%, they can do this usually on a file and use basis, which means that they have to file the rate change before they make the change. So I just mentioned file and use. File and use says that insurance companies always have to file rate changes with the department, but once they're filed, they can use them. Use and file means that the insurance companies can use the rate changes but have to file them within a certain number of days after they make the change. Lastly, there's open competition, where insurance companies do not have to file the rates with the Department of Insurance. However, if the Department of Insurance learns of an excessive, inadequate, or unfair rate change, they have the authority to call in that rate change. And that's the end of our discussion of government regulation of insurance.